Good morning, everyone. Greg, it looks like we have a majority of the participants.
All right, thank you, Dana, and good morning, everyone. Welcome to FFTC's investment webinar. We certainly hope you're doing well during these challenging times. My name is Greg Burris, and I'm Director of Investment Portfolio Oversight and Reporting. On behalf of FFTC's entire executive team, I want to extend a sincere thank to all of you for your relationship with Foundation for the Carolinas. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the chat window. We will address these after the presentation during the Q&A portion of the webinar. At this time, I want to introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion, which will include an update on market conditions, as well as a review of FFTC's fund performance through May 31st. Given the current market uncertainty around the pandemic, we wanted to offer more frequent updates via webinars and performance schedules posted to our website. We will provide an update on second quarter results at our next webinar scheduled for July 22nd. We hope you find the more frequent communication beneficial. I'll now turn it over to Travis to begin the presentation.
Great, thanks, Greg. Good morning, everyone. Thanks for joining us. And I too hope that all of you are well. I'll run through the markets today and talk a little bit about what we see in the current environment, as well as perhaps as clear as we can see in the forward environment. I'll give you a sense of what's been positively and negatively impacting our investment program for your portfolios. So it has, if we measure through the end of May, it has been a really pretty nice collective period bouncing off of the March lows. The March markets hit their lows around March 23rd and had a pretty nice bounce in the last week of March, and then have continued to collectively move forward. It's not been a straight line, and I'll talk more about that as we move forward, but the absolute returns have been quite impressive. So the S&P 500 through the end of May was up about 18% through that 2-month period, taking its year-to-date loss down to just -5% as of the end of the month. The S&P captures a good deal of the leadership in the marketplace, and the biggest, most stable stocks have done the best, which we'll talk about in a minute. And that really helps to drive those returns. When we look at non-US, the absolute returns are also really pretty good. 11% in a 2-month period is a nice absolute return. You can see, though, that the EFA stocks had been down more, EFA being the developed non-US index. Excuse me. And so again, participation, but not to the same magnitude as in the US. And the story is the same with emerging markets, up double digits over the 2-month period, still down about 16% year to date through the end of May. But good participation as the markets globally started to recover. We saw some acceleration of the recovery in the back half of May as states and communities around the world began to open up, as economic activity started to get back to work. And that's been largely in place through the first couple of weeks of June, with the exception of the last 3 or 4 days, where there has been some concern about resurgence of the virus, some question about just how the economic environment will unfold, and market participants took some profits over the last few days after these quite impressive movements quarter to date. Bonds also were up. We'll talk more specifically about the bond market, but if you recall, it was an interesting bond market in the first quarter, and the leadership has changed completely in the second quarter thus far. And so we did see bonds, though, still positive for the period, up a little better than 2% and up about 5% year to date. When we start breaking down the market environment and what's worked and what hasn't worked, it's really been a story of 2 markets still from a leadership perspective, as we saw in the first quarter, and frankly, as we've seen over much of the last couple of years. The biggest, most stable names have driven results, in part because in a period of uncertainty, the market participants prefer to take less risk, and so they're focused on the biggest, most stable companies, and those today sit primarily in the Russell Top 200 Growth Index on our chart here. And they also, if the economic environment is going to be slower, and rates are going to be very low, investors also tend to focus on companies that perhaps have a higher growth rate. So that's why you see the outperformance, continued outperformance in places like the Russell Mid-Cap Growth Index and the Russell 2000 Growth Index, which are the smallest companies. And within that 2000 Growth Index and the broader small cap market in general, you have seen significant market leadership in sectors such as biotechnology, where there's a fair amount of speculation in those stocks. Some of those companies are still pre-revenue, but as investors look at a potentially slow growth environment, then they have been hyper-focused on companies that have the potential in their minds to be able to grow quickly. And so there has been more focus and leadership in the marketplace on that half of the market. The value returns, the more you could more generally consider these companies today as much more cyclically oriented, more necessarily tied to economic recovery. Again, those stocks have performed pretty well. Much of their absolute returns came in the last week or so in April and the last 2 weeks of May. So pretty good, again, really good absolute returns from a double-digit perspective, but not as strong as the growth half of the marketplace. And we continue to see that play out in daily trading, if you will, or the activity of the markets daily. And it's largely based on changing views around the shape of our eventual recovery. Is it a V? Is it a U? Is it a Nike swoosh, which I think is probably my favorite analogy to use as an economic recovery? But the market just doesn't know. And there's a lot of changing data and not necessarily good data every day. And so we do see that these differences continue on not only a quarter-to-date basis, but I think it's quite striking when you look at the calendar year-to-date. Russell 2000 Value, which are the smaller, more cyclically oriented stocks, is still down through the end of May, or a little bit more than 25%. So participants have not necessarily, while there has certainly been a run-up in stocks and certainly good participation in the cyclical names at various points in time, the markets have been they've certainly changed their view on recovery multiple times since the end of the quarter, and that's created quite a bit of volatility that we'll talk more about in terms of how we think about that for portfolio construction. And quality and minimum volatility, which are two other factors that we'd like and have exposure to in our portfolio. Those have done also really pretty well, but just not quite as well as the growthier parts of the index. Excuse me. So fixed income, that market changed pretty remarkably. So if you recall, if you've had a chance to listen to our previous conversations, or if you've seen the materials, you know that in the first quarter, and especially in March, as investors reacted to the equity sell-offs, there was a significant demand for treasuries. And so the U.S. Treasury Index in the first quarter was actually up 8.1%. And there was a pretty remarkable sell-off in the of all things corporate, if you will, both investment grade and non-investment grade, corporate bonds, non-U.S. securities, emerging market securities. Most everything that wasn't treasuries sold off pretty dramatically in March as liquidity went away, and as investors sought safety and sought liquidity in both broader U.S. treasuries as well as in money market instruments. That, as in fact, I may have even noted in our previous conversations, we anticipated that to snap back once more liquidity came back into the marketplace. We've been through periods like this in my career. I've been through it 2 other times, in 2002 and again in 2008, when we saw in a flight to quality and in a short-term drawdown period, we did see the bond market bifurcate. And we saw that again in March. And as we saw coming out of those periods previously, the market liquidity starts to come back, and more discerning, more level decision-making takes heed. And so then you end up with returns that are more similar to what we have here. So the Treasury Index was up 8.1. It's now up 8.6. So it's a modest return. But when you look at the quarter-to-date returns for the broad investment grade corporate bond index, up nearly 7% for the quarter versus that virtually flat Treasury position. And you can see the high yield and emerging markets, of which we have very little exposure, also up really pretty strongly after liquidity and sanity come in. We did see, excuse me, the Federal Reserve has stepped in a somewhat unprecedented way to provide support to these markets, to be the buyer of last resort in some cases. And so that has resulted in liquidity coming back in. In fact, long before the Federal Reserve ever purchased the single security, just the commentary that they would be there helped bring liquidity and stability back to the trading in the fixed income markets, which has led to some of this rebound. We would expect to continue on this path, albeit like all things, we wouldn't anticipate it to be a straight line. If we do see more stress on the general economy, then we should expect to see the corporate bond universe come under a little bit more pressure. We think that's okay. It's natural. It's not ever any fun to have underperformance or negative performance. But as the economy works out, the market works out where we're going, then that will impact these prices as it does with equities. But we still like where we're positioned and given our current portfolio structure. So in terms of the portfolios themselves, we have done 2 rebalancings since late February, and we're in the midst of doing a modest rebalancing actually right now. Equity markets are up a lot. I was just looking this morning through today. Excuse me. Even with the sell-off over the last couple of days, the U.S. equity markets are up anywhere from 15 to 18% quarter to date still, and that's pushed us, that recovery, because we did rebalance near the bottom in March. The recovery has pushed us up above our targets now in many cases with our growth portfolio. So we're doing some small rebalancings just to be mindful of risks relative to our targets and our benchmark. We do think that risk has increased as a result of this COVID virus and the shutdown and the resulting shutdown of the economy. And we don't know how long that will take, but we do know that the market has been quite volatile as it tries to digest that information. So we have been evaluating the excess risk in the portfolio, and we're getting validation that that's the right path. And I use, albeit a short time period, but I use the last 2 months as a pretty good example. Got off to a decent start in April. We had a nice, if you will, pro-V rally, so suggesting the market felt like we were closer to a V recovery in late April. And you saw cyclical stocks in the whole market really trade up. And then in the first 2 weeks of May, the market's view changed pretty remarkably. And stocks in general actually were negative in May for the first 2 weeks of the month. All of the best performance or the most strength had consolidated back into the growth part of the marketplace. And then in the back half of May and up through the last couple of last couple of days, the market had been back to betting pro-V, and we saw the markets really spike. We saw small caps perform and value perform extraordinarily well over those periods. And now over the last several days, we've gotten another significant directional change. So that suggests that there's a fair amount of excess risk in the marketplace, and it's risk that we think it's hard to get compensated for. So we are looking at the portfolio and making some modest adjustments in that we made some modest adjustments in our equity allocation in May. We did increase our allocation to the passive index within our domestic equity portfolio, which we think increases our exposure to quality and stability. And we did reduce our cyclically oriented exposures a little bit, as we want any positioning that we do in the portfolio away from the benchmark. We want to do it at the margin. We don't think it's easy to get paid for making big bets, and so we try not to. But we also recognize that we do have some exposures that create a little bit more excess volatility we're not sure that we're getting compensated for. And so as a result, we've taken some of that off the table. We continue to look at the portfolio to make some additional adjustments to make sure that in light of now where we sit as a world economy, as a U.S. economy, and as a market, are we best positioned to provide the kinds of performance that you need to meet your objectives, and can we do so in a way that adds value? And so we continue to review the portfolios, and we'll make adjustments as needed. When we think about where we might, what might the next several months look like, our view is that while markets have been, they've recovered quite a bit, the earnings and economics data hasn't necessarily caught up with the snapback in stock prices in our view. So if hard data starts to come out over the next several months, and it doesn't necessarily support a V-shaped recovery, then we do think that there are downside risks to equity markets, especially as the market digests what that means in terms of long-term earnings growth. And we expect the data to not be very good. The recent employment number was a surprise, I think, to everyone. So it will be interesting to see how that gets revised going forward. But it certainly caught most people off guard, and that helped to a positive push. But the commentary by the Fed yesterday was not positive. It certainly suggested that from their leadership position that they think things will be longer and more drawn out recovery. And as that data gets digested by the marketplace, we would expect volatility to continue. So just something to keep in mind as you think about your portfolios, and both here with us as well as on your own, that we do believe that there's probably some more volatility to come as the data comes out. So if we transition and talk a little bit about the returns for the portfolios through the quarter to date and year to date through the end of May. So just as a reminder, we do manage on your behalf a series of custom portfolios that are made up of multiple underlying managers across major asset classes, including U.S. equities, non-U.S. equities, emerging markets, as well as a custom fixed income portfolio. We augment that with some other direct strategies that we run, as well as with some other direct managers and index positions that we've used to build out the rest of the portfolio. So we have performed really pretty well. Those direction changes have been challenging for the underlying managers of the U.S. equity, but overall, we've been pretty close through the first couple of months of the quarter. We're a little bit behind the index, but much better participation than we have enjoyed for a while. So we've made some adjustments in that portfolio. We're going to make some additional ones to improve the probability of us being able to outperform on a go-forward basis. But nearer term performance has been better. We're holding up really pretty well thus far in June, but there's still a lot of June left to go. The absolute returns have been really pretty good. The outside of the U.S. equity portfolio, our active management results and the other equity strategies, active equity strategies, have been much better for the quarter. Outside the U.S., in the form of the non-U.S. equity and emerging markets, participation across the universe of stocks has been broader. So it's not been as concentrated in the highest growth portions. Clearly, there's a growth bias globally, but because we own a more diversified portfolio, we have exposures on both sides to both growth and value. Because those markets have been a little bit more broad-based, we've been able to add some premium. Our active managers have been able to outperform in both the two custom portfolios as well as our global highly active strategy and the global opportunities. So really pretty good quarter-to-date performance there. And in two of those three cases, those funds are ahead on a year-to-date basis, albeit negative, but fortunately providing some excess returns. If you watch energy stocks at all, in our portfolios where we own these, we only own a little bit, 1 to 2% in most cases, but we like the diversification that it provides. But you can see after the debacle really that happened in oil in March, oil prices have rebounded really pretty significantly, both on the views of economic recovery as well as some continued work with OPEC in terms of cutting back supply. And so we have energy has been one of the strongest performing asset classes. This natural resources index includes energy and things like materials. Both of those categories have performed really pretty well since the end of the quarter, driven in large part by some of that positive view on economic recovery. But you can see that has been a pretty tough place to be on a year-to-date basis and on a longer basis. When we look at the lower risk parts of our portfolio, which would include our broad hedge fund and custom hedge fund strategy for FFTC, as well as our custom fixed income and our low duration positions, you can see that generally speaking, results have been pretty okay. Our hedge fund through April is ahead of its benchmark year to date, a little bit behind through that month, but still ahead nicely year to date. Our broader fixed income portfolio, if you recall, had a pretty tough relative performance first quarter, but has picked up 2 full percentage points on the benchmark through May. It's picked up a little bit more here so far through June. So as I mentioned in my preamble and market comments, this is unfolding in the direction we thought it would be. I would not have necessarily guessed that we'd pick up 2 percentage points in a 2-month period. So the magnitudes are unique to the time, but definitely the directionality is consistent with what we believe would happen following the sell-off in March. As we talked about last quarter, there was not being shorter duration if you were in corporates didn't really save you, or being shorter duration in anything other than treasuries didn't provide as much downside protection as one might normally expect in owning short duration bonds, just given the magnitude of the activity in March. But you can see across the 3 managers that invest in low duration fixed income on your behalf through BlackRock, DoubleLine, and Sterling, you can see that those managers are all having really pretty nice quarter to date periods, bouncing back nicely off of their also challenging first quarter results relative to their benchmark. They still have some room to go to make up, but again, similar to our core fixed income strategy above on this page, we're along the lines of appropriate expectations, we think, in terms of how these managers are recovering. So that translates into pretty good overall results for the stable of standard pools for FFTC. The cash rates are really low, so the liquid reserves returns expectations should be appropriately aligned there, because there's just not a lot of yield at the money market these days, as there's been a lot of interest in being there. Low duration fixed income, that 3.1%, and the standard pools combination of those 3 managers that I talked about. So you can see collectively they're about 2 full percentage points ahead for the quarter to date, with some ground to make up still on a year to date basis. Really strong performance from income and growth, again, driven in part by the fixed income numbers that we just looked at. Core fixed income makes up 40% of the income and growth, and low duration makes up 20%. So the combined outperformance there, coupled with the good performance from our equity managers, has helped put a nice premium quarter to date for that fund and helps close the year to date gap. Same holds true for the active long-term growth. Not quite as strong a premium, as there's much more equity exposure in that portfolio. It's about 75% to equity, 25% to fixed income. That's similar to the passive long-term growth. Those actually not similar, they're the same target asset allocations between the two, just the active uses active. And so you can see the impact of active management both in the quarter to date as well as the year to date numbers. But again, we're seeing the activity in those portfolios that we would hope to see given the environment, and picking up some premium. And then in the diversified long-term growth, that reflects a slight discount to the index for the quarter. Bear in mind that the diversified long-term growth does own a decent amount of assets that are not priced every day, and as a result, that will result in some lag versus our indexes over any given period. The underlying funds that we have gotten numbers on, we talked a little bit about those already, and we're getting good confirmation, but there can be some slight disconnect in terms of the short-term numbers, but we feel that portfolio as well is pointed in the right direction, and we're doing okay. So I talked about those things. I sort of went out of order on my conversation and my bullets, but big picture-wise, we're continuing to actively manage the portfolios. We're looking at making adjustments to make sure that we're well positioned for a different environment that we look forward to today than we started the year for, and continue to work hard on your behalf. So Greg, that's the end of my prepared comments. I'll pause there. I think maybe we had some questions that we wanted to tackle.
Yeah, well, thank you very much, Travis. We do have a few questions. The first one is, many say that the massive fiscal and monetary stimulus will result in a weak economy years past the pandemic over. Maybe explain why that might happen, and perhaps Mercer's view around that.
So when you have this kind of government intervention, it does a couple of things. It adds to the corporate, or the federal balance sheet, if you will, in the sense that we've approved something to the neighborhood of $4 to $5 trillion of stimulus to help keep us out of a depression. But we have to pay for that as a country, and we'll pay for that by issuing bonds. And the risk to the economy in that situation is a couple-fold. There's the notion, the classical economics notion of crowding out. And so if the Federal Reserve has to, if the US Treasury has to issue more and more debt to be able to support our deficits, then there's an economics theory that suggests that crowds out corporate borrowers and perhaps keeps corporate borrowers and corporations from having appropriate access to capital, and appropriate access to capital could reduce their ability to grow. So that's a potential risk. At some point, I don't know what it is, but logic might suggest that at some point, buyers of US Treasuries are full, and they just don't want to own anymore at rates that we have today. And I didn't see where it was, but the 10-year Treasuries have been bouncing around, call it between 65 and 80 basis points. And that's kind of a tough pill to swallow if you're going to invest for 10 years that you're going to get less than 1% per year. And so at some point, if Treasury buyers their appetite is full for Treasuries, then rates have to go up to make Treasuries more attractive. If we're going to continue to have to float debt, or the dollar has to devalue. Neither of those things are necessarily good for business. Higher interest rates would in general not be great. But at some point, interest rates might have to go up. And if you extrapolate that just a little bit further with $4 to $5 trillion of additional stimulus, if that finds its way ultimately into aggregate demand, you can see inflation. And in an inflationary period, bond owners require higher yields. They require a higher expected return to try to account for the effects of inflation. So rising interest rates could ultimately slow economic growth and cause that recovery to extend over time. And I guess the last notion is, if you take all those things I said and you couple them with a global economy that is largely already indebted, digging out and paying back that debt versus deploying that capital in new opportunities to grow would also potentially put a lid on long-term growth in the markets.
And Travis, this is Tim. One thing I'll add is that I don't think you mentioned unemployment in the U.S., but with the elevated levels of unemployment, that's going to take a while to return to more normal levels. And that's certainly going to impact U.S. GDP, given that consumers represent 60, 65, 70% of the U.S. economy. So we've seen various projections of going from kind of the low mid-teens right now, where we are, to high single digits a year or two from now. But ultimately it's a multi-year, 3 to 5 year recovery before we get back to more normal levels of employment. And that's certainly going to impact GDP in the U.S. as well.
Excellent point. Thanks, Tim.
Okay. Thanks, both of you. We do have a couple of questions in addition to the first one. Given the outlook for a very low interest rate environment going forward, are you considering any changes to the fixed income allocation?
So the short answer right now is no. When you think about the range of standard pool options available to you all, they are aligned in such a way that we have a range of expected risk profiles. And for those that have a lower risk profile, there are just not a lot of options in terms of asset classes to have a lower risk or lower potential risk investment. So we're to be able to maintain a good diverse lineup of standard pool options, the range of fixed income will likely remain pretty stable as to where it is today. In the longer term portfolios, the passive long-term growth, the active long-term growth, and diversified long-term growth, they have relatively light allocations to fixed income. And we would not anticipate taking those down anymore, even though expected returns are low, because it exposes the portfolios perhaps to more volatility than we think is appropriate for what the average owner of those options is seeking. So we do try and overcome some of the challenge in the fixed income environment in the active portfolios by being active and by engaging with active managers that have the flexibility to move around the fixed income market and to try and take advantage of value. And as we know, that doesn't work in every quarter, as we saw in the first quarter of this year. So there will be times when the results of using that strategy will result in some underperformance. But we do think that that's, rather than just taking a passive bond view, we do think that that it's valuable to address that lower fixed income environment by being active, by taking advantage of the spread of different sub asset classes within fixed income. And then even when fixed income doesn't perform as well, or it's only off marginally relative to equities, and we do need to make sure that we have something to sell, to rebalance, to reload into our portfolios when we go through volatility like this. And so core fixed income continues to be a tool that we'll use, and we'll try and do our best to bring value out of.
Okay. Another question for you. It seems rebalancing is based on the expectation of returning to the norm. But when there is a long-term trend going on, it seems that rebalancing increases the allocation to losers and less to winners. Are you okay with this?
That's a very true statement, in the sense that if I say that sentence separately, that's buy low and sell high. And markets, financial markets, are the one place where investors are generally comfortable buying things that are not on sale. But because we do believe that reversion of the mean to the mean works, that markets overshoot to both the upside and to the downside, that by having a discipline to rebalance, whether it be as we did primarily from just bonds to stocks in March, or whether it be rebalancing to some of our active managers that are underperforming, or their sub-styles are underperforming versus others, and rebalancing to those positions. Through the brace of now 100 years of market data, one of the prevailing themes through all those different market cycles, that there is still a tendency for these asset class returns to mean revert. And so if we get really strong upside returns, then we should trim some of that and redeploy it in the parts of the market that haven't worked as well, because the expectation is that they will change and rotate over time, and those rotations are incredibly difficult to guess correctly before they happen, and We don't think there's a lot of ability to add value by trying to time flipping in and out of these positions to try and catch that trend. So the best, most disciplined way to do it, and we've not only through our experience, but we've also, and others in our industry have run lots of studies to test, what's the marginal value of rebalancing. And it not only does periodic rebalancing add return over time, but it also does so while reducing risk. And so while it's hard to think that the growth part of the marketplace today will ever underperform, in 2016 it underperformed by a lot. Magnitude's not quite the same as they are today between growth and value, but value outperformed by a ton over a 18-month period that you could have easily been asking the same question. You'd just be questioning which the losers were. So we do believe in mean reversion. We do think that it works. I do think cycles have gotten longer, and so that will have some impact in terms of how rebalancing, quote unquote, works in terms of that risk return trade-off, but we continue to believe that's the right path.
Okay. One last question. With the recession and actions by our Federal Reserve, have your capital market assumptions for the future changed? If so, what strategic or tactical changes have you made or are thinking about?
Excellent question. So we do update our capital market assumptions on a quarterly basis, which so the last several quarters have meant we've been quite busy doing that process because this market seems to change quarter in and quarter out. Generally speaking, ahead of this quarter, because we'd had a drawdown, that it does bump up our long-term expected returns a little bit because we measure from the point forward. So if I were looking 10 years out from the end of March, those expectations, all things being equal, might be modestly higher than the 10-year returns at the end of December would have been, following the great year that 2019 was. Depending on how the next couple of weeks go, I suppose we'll take another look and they might move. The notions around our capital market assumptions, they typically don't change remarkably because we're forecasting 10-year returns, we're forecasting 20-year returns, and then if sort of a less determinate time period of equilibrium type returns, and those returns are all related to one another in terms of what we think over the long term, how does that translate into a 20-year period, and then what do the next 10 years look like to get you to the 20-year period. So they will change modestly. It has not, for some of the same reasons around my question on around my answer on fixed income, hasn't changed our views necessarily too much on strategic positioning, because we still need to have exposures that generate the risk and return profile that we think is appropriate based on what the market provides to us. So, for example, our expected returns for non-U.S. securities, especially emerging markets, is high, but are higher relative to other parts of the equity markets. But it also carries the price of risk for that, a security like that, is also higher than other parts of the equity market. So while it might be helpful in our model to help push up expected returns, it also pushes up expected volatility. And so we don't find ourselves in a position to be able to move it around too much, just to keep the balance within the portfolios that we seek. On a more tactical notion, we don't do a ton of tactical work. Again, from my earlier comment, that's really hard to get tactical moves correct. I did mention, and we have reduced some of our cyclical exposure, and we'll likely do some more, only because, not that we are unconvinced that we shouldn't own that sounded wrong, let me say that again, that we're convinced we shouldn't own cyclicals. It's just that the excess volatility in the marketplace isn't providing enough compensation for our return potential. And so we're experiencing probably more excess volatility than we like, and we're not getting the returns that potentially could go along with that. And we think that kind of market environment could extend for a while, given all the things we've talked about in terms of our forward view. Tim's comments on unemployment, we just think there's some excess risk. And so from that perspective, while that hasn't necessarily impacted our capital market assumptions on a long-term basis, it clearly informs our more dynamic views over the shorter term. And as a result, we just think taking fewer relative risks is a safer and more a stable way to go, so that we can again try and seek premiums on behalf of you and the organization, but to do so in a way that doesn't expose you as investors to excess risk that you won't get compensated for.
Okay. Well, we do not have any more questions. So thanks, Travis and Tim, for your insight and update on the markets and review of our portfolios. And thank you to all the participants in today's webinar. We do appreciate the relationship we have with you, and we will be notifying you of the next webinar currently scheduled for July 22nd. Thank you, and that concludes our webinar.